Welcome to the Restaurant Boiler Room, Episode 1. I'm your host, Rick Ormsby, Managing Director at Unbridled Capital. Today in the Boiler Room, Amazon minimum wage hike to $15 nationwide could cripple restaurant valuations. Inspire Brands acquires Sonic, what this means to Sonic franchisees. KFC Leadership Change, why it shouldn't impact the KFC domestic business. And our question of the week, what does the rising 10-year mean to valuations? The Restaurant Boiler Room is a one-stop shop for multi-million-dollar merger and acquisition activity and financial complexities pressuring the franchise restaurant industry. We talk money, deals, valuations, and risk, delivered to the front door of franchisees, private equity firms, family offices, large investors, and franchisors across the world on an every other week basis. Feel free to find all of our content at Unbridled Capital's website at www.unbridledcapital.com. Now, let's enter the boiler room. Amazon's $15 minimum wage hike nationwide could cripple restaurant valuations. Background on this was it was announced on the heels of the September 2018 unemployment numbers being released, which showed a drop of 0.2% to 3.7%, the lowest unemployment rate since 1969. Now, why is this important? Competition for labor is intense right now for franchisees looking to fill team member positions in their businesses. The most common complaint I hear from franchisees is the inability to find qualified workers. And they're also bemoaning the intensifying competition from places like Walmart and Target and now Amazon. And then specifically to the pizza business, you hear Pizza Hut franchisees and other pizza franchisees concerned about Lyft and Uber and third-party delivery platforms competing for their delivery drivers. Let's take a quick example of how this might affect a franchisee's business and affect M&A activity. Let's say, for example, a restaurant is doing $1 million in sales with 30% labor, 2/3 of which is variable, and the average hourly rate goes from $10 to $15 per hour. In this particular example, labor would increase in the restaurant by $100,000, assuming no pricing increases. And if the average franchisee is running a 3 or 4% profit margin, which is typical for the industry, this labor increase would make the restaurant immediately unprofitable. Ouch. And since restaurant valuations are calculated as a multiple of EBITDA, unprofitable restaurants have no or little value. And this multiplying effect of EBITDA multiples means a massive change in value when profitability goes up or down. I've personally seen the ravaging effects of $15 minimum wage on restaurant companies operating in the Northwest on the West Coast. It would not be a surprise to me to see 10 to 20% of all restaurant franchises close on the West Coast in the next few years because of rising labor costs. So I would tell you to keep a watchful eye as this trend of rising wages continues to creep, even into the middle of the country where it's largely unexpected and muted right now. Our next topic is Sonic, which got acquired by Inspire Brands. Now, what does this mean to Sonic franchisees and their valuations? The background here is that Inspire Brands acquired Sonic for $2.3 billion, or announced the acquisition. Inspire owns Arby's, BW3, R Taco, and now Sonic. Roark Capital is the largest shareholder in Inspire Brands, and among other franchise companies, Roark owns Hardee's, Carl's Jr., Jimmy John's, Culver's, and Massage Envy. They're a real powerhouse in franchising. The announcement indicated that Sonic headquarters will stay in Oklahoma City. This is a continuing trend of consolidators in our industry. First was Yum, of which I am an alumnus. Yum owns KFC, Taco Bell, and Pizza Hut. Restaurant Brands got into the game and is a recent entrant and now owns Burger King, Popeyes, and Tim Hortons. JAB Holding Company, a Luxembourg private investment firm, owns Panera, Krispy Kreme, Einstein Bagels, Pret A Manger, and several others as well. Now, how will this affect the M&A industry? Roark has historically invested in management, allowing its businesses to continue to run with little perceived interruptions from my perspective. However, senior management changes at Sonic are likely here. Several franchisees have told me that it's time for a leadership change at the top at Sonic. Also, during post-acquisition integration, marketing and advertising can sometimes suffer when new organizations try to figure themselves out. If this happens here and sales drop, we could see lower valuations for franchise businesses at Sonic in the near term. So Sonic has languished a bit this year and is regaining and trying to regain momentum, which is a very delicate thing and can come and go quickly in the incredibly competitive burger segment. of the restaurant business. From personal experience, I guess I have a conflicting opinion here. If you believe many franchisees, this acquisition could result in a meaningfully positive change in the direction of the Sonic brand. Experience tells me, though, that big ideas will stall at Sonic for a few quarters while the post-acquisition integration takes hold. Using an example of Jimmy John's to kind of make the point. So don't be surprised if we see a short-term lull in Sonic M&A while franchisees wait on the sidelines to see what happens. Let's just hope that sales don't take a hit in the meantime. Our third point for today is KFC Leadership Change and why it shouldn't have an impact on the KFC domestic business. The background here is that Tony Lowings is going to be replacing Roger Eaton as CEO of KFC Global. This is an internal promotion. Tony worked for recently in the KFC South Pacific area and was managing director of Asia Pacific. Now, why is it important? KFC Domestic has had a great 4-year run. It's been a fantastic turnaround. Sales are up on a multi-year basis. Assets are looking good and getting remodeled. I'm sure you've seen them across the country in your hometowns. Store count has stabilized at KFC domestically. New product offerings have been successful largely, and advertising has been a hit. Leadership changes are always a time to pause and consider if this successful trend will change or not. Given recent KFC U.S. successes domestically, it would be a surprise to me if this leadership change would result in anything meaningfully different here in the U.S. The KFC M&A market continues to be super strong. Business valuations eclipse 6.5 times EBITDA for the best and largest KFC businesses now, which is a dramatic increase over several years ago, not just on a multiple basis, but also on an absolute dollar basis because the business has grown. Some larger legacy KFC franchisees are now selling in the U.S., which is a nice balance to a system that has a lot of smaller franchisees, 1 and 2 unit mom and pops, who've operated for 40 or more years. From personal experience, in my opinion, would be that we won't see much change. Kevin Hochman has a marketing background. He's done a great job with the advertising of the ever-changing Colonel Sanders. Positive results should continue with the brand, even though we do have some sales and traffic concerns, not just for KFC, but the entire industry as we move into 2019. Finally, let's talk about the question of the week. What does the rising 10-year mean to valuations? The background here is that the 10-year Treasury started 2018 around 2.4%. It has been steadily rising for much of the year, reaching a 7-year high of almost 3.25% on October 5th. Since then, it has backed off a little bit and is trending in the range of 3.15% as of October 18th. Why is this important? The 10-year is a very good measure of interest rates and cap rates, both of which affect restaurant valuations. Cap rates and restaurant valuations move in opposite direction on a direct and immediate basis on the real estate side. Interest rates also have a moderate impact on restaurant valuations. Higher borrowing costs ultimately lead to lower valuations. So how will this affect M&A? To this point, most restaurant valuations are higher this year, depending on the brand, largely ignoring any effects of the rising 10-year. Real estate valuations are also largely unchanged, likely because of the high amount of cash in the marketplace to do deals and the chasing of yield across all asset classes. But the trend of sky-high valuations and rising interest rates can't continue together forever. I'd expect both business and real estate valuations to get pressured in 2019 with continued momentum from the rising 10-year. We've been in a very low interest rate environment for a long time. The Fed has hiked interest rates 3 times this year already, and most economists predict this trend to continue. For now, sellers and buyers should continue to take advantage of record valuations and still cheap money. But watch for this trend to slowly change in the next 12 to 24 months. Thanks so much for entering the Boiler Room today. You can find our content on iTunes, Google Play, Stitcher, and Spotify. If you like these podcasts, please listen, rate, and review. I also encourage you to visit our website at www.unbridledcapital.com for the best franchise M&A content and financial resources in our industry. Our website includes podcasts, videos, white papers, and a list of our M&A transactions. As a final disclaimer, please note that neither Rick Ormsby nor Unbridled Capital LLC give legal, financial, or tax advice. These podcasts represent opinions that have been prepared for informational purposes only. We expressly disclaim any and all liabilities that may be based on this information, errors therein, or omissions therefrom.